Hello, everyone. Today on the final bar, we'll talk market digestion, I guess. Digestion days are those days like this where we sort of take a pause that refreshes. We digest the previous gains. It's not a move to new highs, but it's more of a backing and filling sort of day. We saw it, but resilience, resilient moves in the financial sector. Also, airlines up huge today. My guest, Greg Harmon from Dragonfly Capital, going to join us as well. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to digest the movements of the day, make sense of the charts together, look at the short-term movements, but most importantly, connect the short-term fluctuations we're seeing today with the long-term trends. And I think, a long-term trend-following approach, a momentum-oriented approach, where you're identifying what's working and what's not. You're leaning into what is working. You're leaning away from what is not working. That is the way that you, over the long term, tend to do pretty well in terms of managing risk and taking advantage of reward. And the risk management side is getting out of what's not working, and don't minimize the value of that in your process. It's interesting as you're looking at how things have evolved. My guest, Greg Harmon, is going to talk a little bit about some areas of the market that are starting to improve, particularly in the financial sector, and financial stocks up again today, 2% on a day when the S&P's sort of flattened down a little bit. So a lot of charts to look at and a focus on relative strength later in the show. Before we get any further, though, I just wanted to point out some of the great guest presentations we're going to have on this show and elsewhere on StockCharts TV. As I mentioned, Greg Harmon from Dragonfly Capital joining us on the show in a little bit. Next week, we have three great guests. Dana Lyons on Tuesday the 9th, on Wednesday the 10th, Mark Ungewitter, and on June 11th, Xenia Taubina is going to join us for the first time. And so it'll be interesting to hear a couple different takes, some of those strategists, some of those money managers, and it'll be great to just hear how they're dealing with this market that just continues to be resilient, continue to chip away at further highs. Two other things to point out to you. On Monday, our next episode of Behind the Charts is a conversation I had with Price Headley. Price is an options expert, does such a great job of making sense of the options world, but in particular talked a lot about, in our conversation, about the mental game of trading, whether it's options or any other asset, and some great thoughts about how to deal with the stress of the market environment. Then we have a very special event coming up on July 13th called Charting the Second Half. This is where we're going to have an entire week-long event on StockCharts TV featuring fantastic guest presentations, market outlook panels, and a lot of other great content as well. So mark your calendar for the week of July 13th. It's going to be a very, very special stretch of programs. Let's get on to our market recap. So as I mentioned, ended up being sort of a mixed day. And depending on where you look, you probably felt like today was pretty good, or it was sort of a pullback day. And I've actually seen reactions on both sides of that, to be honest with you. On the positive side, the small cap index up 1.4%, not bad. The financial sector up 2%, not bad. Airlines up huge, with something like American Airlines up, I don't even remember, 30-40% or something ridiculous. And again, airlines up as a group almost 13% at the close. And this is announcements from American Airlines talking about sort of restarting their schedule, ramping out and building up their schedule back to, sort of pre-coronavirus levels, a lot more from the restricted scheduling that we've seen up until now. So all the airlines up sort of in concert with that. So if you're looking at any of those things, you probably feel pretty good about the world right now. On the downside, the S&P was down 1/3%. So actually, and at times down a lot more. It got below 3,100. Rallied pretty well into the close in the last hour, but at one point felt like it was continuing to swing further down. The Nasdaq down 0.7%, Nasdaq 100 0.8%. The VIX increasing up to almost 26 again. If you're looking at technology, healthcare, which had been leadership areas that are starting to, underperform, they were both down 0.8%. So again, I feel like this was a day where if you were bullish or bearish, you can find some reasons why to justify it. And again, that what I just described is called confirmation bias. That is not what you want to do. Let's focus on the trends themselves and see how they're evolving. So I've sort of laid out on the equity picture what we've seen. Let's look at some other asset classes, then we'll look at some of the charts together. So bonds continuing to pull back. You've seen this rotation away from bonds and really into stocks here and at times into gold and other assets. But 10-year yields increasing now up above 80 basis points. With the TLT down almost 1.5% today. On the commodity side, you saw gold go higher, finished up about 1%, oil up a little bit more, but overall the entire commodity complex pretty much in the green here. Let's look at a chart of the S&P. I'm going to talk to Greg Harmon from Dragonfly Capital in just a little bit. Be interested to hear his take on this on the markets, but. You know, from my perspective, I think at some point along the way, from March 23rd to today, I think something probably has hit you. There's some moment along this chart where you finally had to mentally throw in the towel and decide it is no longer bearish, it is bullish. And some early adopters, maybe in that first pullback out of the lows when we had a higher low that was pretty confirmed and we continued to go to swing highs, broke above that first Fibonacci level. I think that's the more aggressive version of considering the bottom to be in place, which ended up being pretty good. For me, you know, I was thinking, you know, as long as we remain below this sort of confluence of resistance, the 38.2% resistance level, what ended up being the previous highs here from the end of April, we sort of hit that. The 200-day moving average all sort of lining up in this 2950 to 3000 level sort of felt like the logical place for a stopping point in a bear market rally. Since then, we've resolved higher. And I think even though we are well overdue for a pullback, we certainly could and should digest these gains at some point. And I would think pulling back to 3,000 is a really ideal sort of pullback sort of point. As long as we remain above there, though, I think you have to feel that the evidence is leaning more positive than negative. The trends are sort of supporting that. Any of the negative signals we've gotten are not from breadth readings, it's more from rotation. So technology underperforming and financials outperforming is more identifying the sector rotation. It's not indicating a negativity to the fact that tech is underperforming, which is surprising to me because when tech rolls over, the question is what's going to take its place. And for now, it's been financials, it's been industrial. So we'll have to see how that continues on. But at this point, short-term trend, that medium-term trend, all continue to aim to lean more positive. And I think that's sort of the general feel to what I'm seeing on the charts there. We talked a little bit about the sectors. As I mentioned, financials up the most, over 2%. Industrials up 1% as well. On the downside, utilities and real estate, the two worst sectors. And again, those are pretty heavy defense, high dividend paying areas of the market, which sort of makes sense on an overall bullish tape. Those would generally tend to be on the bottom, although don't always assume that. There are times when utilities have certainly done very, very well on a relative basis, even in a bullish phase. Technology, communication services, healthcare, all down more than the market, so underperforming today. As I mentioned, in terms of the big gainers, sort of rotating down to the breaking the equity market down into a little more clarity. The number one stock. This is how I was following the rally in airlines. AAL was the number one gainer in the scooter rankings. Rallied up pretty good as the price just jumped very, very quickly. The airlines group up 13%. And again, it's not just AAL. If you look at JetBlue or Southwest or Alaska or any of those other stocks, they're all sort of in different phases. American Airlines certainly looks the most vertical of all them. Here's the chart of AAL. We'll refresh it here for a second. But you can see how, it had been sort of this basing pattern, but still making this pattern of lower highs, coming off a lower low there. And 9 was sort of the bottom in the market so far. This is certainly changing the character of the chart with the relative strength, the price increasing. It's now overbought for the first time since last October. So the question, obviously, with any of those big runs, it's up over 40% today, is what's the staying power, right? What sort of follow through do you get as you digest that? Now, what's good about some of the other airlines is they are less extreme. While American Airlines went completely vertical and JetBlue's still up over 15%, it's a little more orderly of a turnaround, right? So you have the resistance here from that initial push off. So while the S&P had that big rally, pulled back, and then just continued up now past its 200-day moving average. What happened with the airlines, the big jump up, but then they kind of came and they spent their time backing and filling in this range. That's why the relative strength remained relatively muted to negative, to be honest with you. Since then, though, look at how the relative strength has improved. And we've looked at airlines a little bit. This is putting it certainly on my radar, seeing the extreme jump that you see today. So again, on something like this, if you were there, that's great. If you missed it, it's all about what to do next. And I think on a big move like that, it's pretty normal to expect some sort of pullback, some sort of pause as everyone makes sense of the fact that airlines are now at that level. But overall, the trend now positive. These stocks all or nearly all overbought, and that suggests, in general, just tells you that they've been up a lot. The question now is, where do we go from there? Interesting to note, a lot of the financial sector, the financial sector up the most today, up 2% on a flat day for the markets. Banks were one of the top 10 groups. Fifth Third popped up as one of the top gainers today, and I think again interesting here to see the rally that you can tell with again higher highs, higher lows. So it's not a huge surprise that the stock keeps going higher, but just continues to trip higher. And I think that's where the relative strength now starting to participate. This had rallied along with the market, which is why the relative was flat. And then we see a break to new relative highs. That's what's kind of sort of coming in this week. That's how this week is feeling a little bit different than some of the previous phases. So that's a bit of a market recap. And again, a lot of movement, and again, a bit of a divergence now between financials on one side, between technology on the other. We're going to take a quick commercial break. We're going to dig into some of those themes with my guest, Greg Harmon from Dragonfly Capital. We'll see you here in a minute. Hello, everyone. Welcome back to the show. This is Dave Keller here at StockCharts.com. As a reminder, we love hearing from you, love getting your questions. And part of this show and StockCharts TV is to help you navigate these markets, empower you to make better decisions. So questions along the way on technical indicators, on setting up charts, on particular tickers and what you're seeing, and just double checking your approach, your analysis. Let us know how we can help. Just shoot us an email, thefinalbar@stockcharts.com. We'd love to help you get more comfortable with what you're seeing and what you're hearing out there. Along those lines, we have this situation where the market continues to be resilient. A bit of a digestion day today, and coming on the show to help us try to make sense of it, Greg Harmon from Dragonfly Capital. Greg, welcome back to the show.
Thanks for having me again, Dave.
So you sent some charts ahead of time, which is fantastic. The first one, it's interesting. We've seen commodities and how they've evolved in EM. While so many people have written off international markets, certainly starting to come to their own here. What are you seeing right now in the emerging market space?
Yeah, if you look at the chart we have up here, you wouldn't have expected it maybe against the backdrop of. I know you've had Peter Brandt on and Frank Capillari on the last couple of days talking about the dollar dropping and talking about interest rates rising with the treasuries falling, which would create more of an inflow into the U.S. But really what it's doing here is creating more of a risk-on environment. And that's what I see here in the emerging markets ETF. We've got a breakout. I drew it here with a kind of a rising trend resistance. You could certainly go across to that March 11 day, the red candle right above, right there, and draw it straight across and show a major breakout here to a 2-month plus high. This is a big thing, a big turnaround for emerging markets. We get a little pause today as we hit the 200-day moving average yesterday. These charts are as of yesterday's close, and we had a little pause and pull back into the Bollinger Bands today, but still a really bright picture. It's a good time to be involved in emerging markets, I think.
It's interesting. I'm always looking for sort of that thing that I think people are mentally unprepared for, and I think so many people have written off strength in non-US markets for so long that they've probably even stopped looking at charts like this because it just hasn't paid to be there. But you're pointing out some interesting developments. Now, another sector that I think a lot of people stopped thinking about, and now you have to kind of pay attention, is the financial sector. Again today, sort of the top sector out of the 11 S&P sectors. You're highlighting Cincinnati Financial today. What are you seeing here?
Yeah, and people have been talking about the last couple of weeks about are the financials ready to break out? And when we talk about the financials, most people think about XLF or KBE, like the banking indexes, and those do look ready to break out. But another one that maybe you should start following is something called the KIE. The KIE is the Spider Series Insurance ETF. Now, we've seen a lot happen over the last few months around companies like Anthem and more health insurance related companies.
Right.
But Cincinnati Financial is in that category as well. And Cincinnati Financial shows itself as a really, really deeply beaten up stock compared to the others in the sector. Most of you see the chart here where the Bollinger Bands are starting to move up, but price is still well below the 38% retracement level. All the banking indexes, the insurance index are all at least at 38%, if not 50% retracements already. This is a big laggard, and it's starting to turn around. You can see the momentum starting to pick up with the RSI poking up through the midline. You've got the MACD there at a point where a little bit higher, and it'll be making a higher high as it approaches zero. And you get the Bollinger Bands opening up. This stock looks like it's ready for a big retracement.
I knew I could trust you, Greg, to bring an Ohio name. So thank you for that gift. The last thing, we only have 30 seconds left. And just while I have, when we're thinking about the broader market, I mean, you saw EM setting up pretty constructive. Cincinnati Financial and the financial sector in general starting to look attractive. When you're looking at the big picture, just real quick, do you see us returning back to S&P 3,400? Do you think that's an unrealistic goal? What are you looking at when you're looking at the S&P chart?
I think it's a realistic goal, but I think, when I look at it today, I've got my Fibonacci's on it, and we hit the 78.6% retracement yesterday, and then we stalled there today. And obviously, we've got a big catalyst tomorrow in the non-farm payroll number that could have caused a little profit taking today. The next big number for me is the 88.6% retracement at about 325.60 on the SPY. So about 332.60 on the S&P, which is essentially right where that gap is that started this whole thing in February. 88.6% is often a place where things pause or reverse back down. So I'm withholding judgment on the retracement to 3,400 until we get through that level. But I think 3260, 3250, 3260, I think that's probably in the near future.
One step at a time then. Greg Harmon, thanks for joining us from the Cleveland area today. Hope you and the family stay safe, and we'll look forward to having you again on real soon, all right?
Thanks for having me, Dave.
So that was Greg Harmon from Dragonfly Capital. And again, what I love about Greg's work is he does a great job of using stock charts just to illustrate movements that I feel like when he's showing me, I feel like, why did I not catch some of the movements in emerging markets? And again, what surprises me, and I think what may surprise some of you, we've talked a little bit about the weakening in the dollar, and we've had the dollar as a discussion with a number of my guests recently. But I think, what I take away from Greg comments is just that, at some point you have to acknowledge trends that are starting to work. Even if you've not been thinking about it, the point of trend following is to follow the trend. So identify the trends that are emerging, identify the trends that are there, and try to stick to them. Having said that, our next segment is called It's All Relative. And what we love to do with a good regularity is focus on relative strength. I talked a little bit earlier about the strength in financials, the underperformance in technology. Greg pointed out a great chart, Cincinnati Financial, with again, emerging relative strength, which a lot of the financial stocks are. So what I wanted to do is just focus a little bit on relative strength winners and see where the positive moves are coming for, and also look a little bit at some of the losers, some of the underperformers. I have a chart list which is called ratios, and if you're interested in some of this work, a big part of my process is looking at ratios and sort of comparing the relative performance of Group A versus Group B, or Stock A versus Stock B. And I found a lot of times, especially for institutional investors, it's a common way to just understand where they should be leaning between different sectors, between different styles. And I found a lot of advisors, a lot of individual investors don't use this sort of analysis as much as they should or they could. So if you're interested in this, if you go to the chart pack page, and all you need to do is go to your dashboard, go to your chart list. At the very bottom, there's a little button that says install chart packs. You will find a group for me called something about Dave's morning coffee routine. Install that, and if you create a new login, they're actually automatically installed now. And this is one of the chart lists that you actually have on your own login. So I'm going to walk through a couple of these. We talked about this one first. This is a common way of looking at the relative performance, relative strength of consumer discretionary versus consumer staples. So this is going higher, consumer discretionary outperforming. If it's going down, consumer staples is outperforming. As you can see, since the March low, that was the bottom in this relative strength. The market actually bottomed out here on March 23rd. So this ratio actually bottomed out a little bit earlier, but overall you can see that it's been in an uptrend since the market low. And so what it tells you is, even with that big spike from staples, and that's the move down in the ratios, and all those staple stocks were rallying, as the market's selling off, this is really hurting that sort of this overall phase. Then you can see the rotation higher, and this is as consumer discretionary names have emerged and been stronger coming out of the lows than the consumer staple stocks. That was a lot of Amazon back here, but what's happened since then is you can see the equal weighted version as well increasing. So continuing to show a rotation of investors away from the safety of consumer staples, more onto the offensive side of consumer discretionary. And it's no longer just the Amazon, Home Depot, mega cap consumer names, it's the average consumer name. And that's why you can see this equal weighted ratio going higher. Second thing, and this is why we put the segment in today, is just a lot of interesting movements right now. The relative strength of semiconductors, it tends to be a good market indication in my process. A lot of times I'll just guide off of the relative strength of semiconductors. If semis are breaking out, that tends to mean that the market overall is doing pretty well, because it tends to be a decent market barometer. If semiconductors are struggling, that tends to mean the market overall is not doing as well, making a new relative high, and it was eclipsing the relative peak from the end of March here. So sort of moved along with the market for a while, coming out of the lows, now accelerating and making a new relative high. So the strength in semiconductors certainly speaking to the strength of the overall market. The next one we've looked at recently is the ratio of financials to technology. And if you look at how long this line has been going down, and that's nothing, the next chart is an even deeper history. There's been a chronic story of underperformance for financials relative to technology, which makes sense if you think about some of the stocks that make up those different sectors. But it's interesting to see how this has rotated higher. This ratio is above the 50-day moving average for the first time since the end of last year. Overall, while the trend has been down, starting to potentially indicate a reversal higher, and this has been magnified by days like this where financials up, technology down, and it just continues to show this rotation away from tech and into financials on a relative basis. So even though both of those sectors could be going up, it's about which one is outperforming the other, and that's where financials have certainly gotten the upper hand in the last month or so. Here's that longer term trajectory, and that uptrend that you're seeing is just this little blip after this huge long-term underperformance. So as a sector, as a long-term play, it's been really hard to justify owning something like a big bank over a big tech stock. And I don't think, even with the rally that we're seeing now, I don't think that's enough to tell you that this overall trend is reversing. It's still earlier on. So remember, the secular trend is still favoring technology over financials, but in the short term on that tactical time frame, it's telling you that something's a little different. Another way to look at that previous one is looking at the ratio of the Qs versus the diamonds. This is a tech-heavy index versus a more diversified index in the Dow. And again, the Dow Industrial is not the most diverse index. It's 30 stocks, and they're all mega cap names. But you can see how this ratio is turning lower, and that's a different characteristics. The market rallying, but the ratio turning lower. And again, what that tells you is basically that the Qs underperforming the diamonds, the NASDAQ underperforming the Dow. It's similar to looking at the relative strength of technology and essentially showing you that this outperformance of the NASDAQ 100, which has been such a consistent bet, starting to turn, and it's below its 50-day moving average for the first time since last October, which is a pretty long-term trend potentially reversing. If you didn't know that the market was up, this might tell you, this might be bad for the overall market, that this is rolling over, because tech has been the leadership. But what this is showing you is it's not the end of the world at this point. I mean, now if we tank from here, we can all look back and identify this divergence as the ultimate signal. But at this point, I think it's more indicating a change in character. It's telling you that the leadership is changing, and other sectors outside of tech are starting to emerge in a position of strength. This is one that I wanted to point out to you. I just sort of looked at this when I was thinking of consumer discretionary versus staples. I was looking at financial versus tech, sort of mashed the two of them together and said, what about consumer discretionary versus technology? These are two traditional leadership areas of the market. You can consider them both offense, although tech has been so good as a defensive play. And if you look for the last year, the ratio overall has been going lower, signaling how, in general, technology, especially the mega cap tech names, have been the strength. And it's not just in the market uptrends. As the market rolled over, you can see how the relative strength really leaned more on the side of technology. Since then, though, this ratio has put in higher highs, higher lows, and it's nearing a new swing high for the last month or so. So indicating a rotation again away from tech into consumer. So consumer discretionary, financials, all emerging to compensate for the fact that technology is not the dramatic outperformer that it has been up until now. So the point of all those ratios, just to show you some of the relative strength stories, it's not just about individual stocks. And I'd remind you, anytime I'm looking at an individual stock, you will note the relative strength almost always at the bottom. This is just showing you the performance of that stock versus its benchmark. But I would say another way to think about relative strength is looking at ratio relationships to identify which sectors are emerging to outperform others. And right now, especially with tech starting to taper off, look for some of those other areas that are emerging to outperform that key area. All right, so now we need to wrap the show, go right to the 3 in 3, 3 charts in 3 minutes, and here we go. Chart number 1 is looking at the percent of stocks above their moving averages. We've looked at this chart regularly, so hopefully this is not unfamiliar territory if you've watched the show for a while. I just wanted to point out that as of today, over 50% of the S&P 500 above their 200-day moving average. This is actually going through yesterday's close. So this 50% line is actually pretty significant. We've talked about the stocks above their 50-day spiking from 0 to almost 100% now, which is an unprecedented swing, to be honest with you. But now what we've talked about is that, I would feel much better about overall market stability if over half of the S&P were above their 200-day moving average. That's now happened with the indicator going above the 50% line up to 51%. We'll have to see through the remainder of the week. It's good at the end of the week to lock that in and see if that remains stable, but that's where we're at right now. Chart number 2 is looking at utilities, and we've looked at sector rotation recently, and one of the things I pointed out was sectors like utilities approaching their 200-day moving average from below. If you think about the S&P 500, approached this right at the 3,000 level, has now eclipsed that and moved higher. Utilities is actually stalling right at its 200-day. It pulled back today with the XLU going up below 60 for a bit, finishing a little bit higher, but overall potentially failing, and it's hitting resistance, hitting the 200-day. You can see the relative strength overall has been more negative, and even though it jumped a little bit, starting to roll over a little bit. So I would be concerned if you're in utilities, whether or not it's able to eclipse that 200-day. I'd want to see that to feel better about the relative strength profile for Utes. The third chart is looking at the bank index. My guest, Greg Harmon, was talking about Cincinnati Financial, and we talked about the financial sector relative to technology. So it's been, certainly a focus on a sector that continues to be at the top of the daily returns list. So you have to kind of think about it. The banking index, which is the $ BKX on our platform, looking similar to some of the bank charts we've looked at, breaking to new swing highs, pulled back a little bit last week, but now again, it's sort of a short-term pullback before the next leg higher. I'm seeing a chart with higher highs, higher lows, and what's most interesting to me is the relative strength threatening to break out to a new 3-month relative high. So in general, if I'm looking at stocks and groups and sectors making 13-week relative highs, I feel pretty good about being there, and the KBW right about at that point, the KBW banking index. That's our show for today. I want to thank you all so much for joining us every weekday on the Final Bar. Special thanks to my guest, Greg Harmon from Dragonfly Capital, joining us from the Cleveland area. As a reminder, shoot us any of your questions. The Final Bar at StockCharts.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.